Hello everyone, welcome back to my channel. So this video marks the beginning of week number 50 in this Road to 100k Realized Return Challenge. Yeah, it's been a wild and long ride, 50 weeks already, and I think it's fitting that we shift gears in this milestone week. And as you can see here, there are a few trades that I did already and I'm going to explain those very briefly. So basically, following up on last video in which I explained that we're going to start to explore some possibilities in terms of the earnings that are upcoming for specific companies, and as things stand at the moment, we decided to go ahead and use the Alcoa Corporation, whose ticker is the AA. And basically what we did is a long strangle here, as you can see here. So we bought out of the money put and out of the money call, and then we sold also a put with the same strike price as this put to basically make the strangle a little bit less expensive. And so what this basically means is that because we bought calls and we bought puts, we will win. Of course, we are expecting that some sort of a large move will come, of course, up until the maturity, and use this put basically to offset some of the cost of this strangle, because at the end of the day we are buying two long positions, and so we are paying a larger amount of money, and so this offsets some of the cost. Now I can make a more detailed explanation later on, but basically and to explain here what is going on is that, assuming we have a graph over here, we use the 30.50 strike price here and the 31 strike price here for the calls, right? And so basically we have, with this strangle, we have something like this. So the put goes like this, and the call, I would use another color, and the call goes like this, right? And so because here is 0, all right, this is our profit, and this is 0, we win if the stock either only on the strangle, of course, we win if the stock has a large move to the downside or to the upside. So if it goes to here or if it goes to here, we should win. However, as you can see, we also sold a put with a strike price of 350, but keep in mind that this put expires earlier. The Alcoa company will have its earnings, as you can see here, using the Yahoo Finance. It will announce its earnings on July the 16th, right? So it's going to be Wednesday next week, and so the plan is basically to, at the end of this week, we expect that either this put expired worthless, or if it is in the money, we will be able to buy it at a lower price than the one that we received it when we sold it. Why is that? Because pretty much all the time value will be gone, and so we will just be paying the difference between the strike and the actual stock price. And this is, of course, the plan. And at the same time, we will sell back these puts and calls that we bought, and depending on where the stock will fall, so if it falls or if it rises, if it falls, the put will become much more valuable, than this one, all right, and we will be able to sell it at a profit. Or if it rises, the stock rises, the puts will become worthless. So this one will be losing on this put, but we will gain a lot on this call. So, and of course, because of the at the same time, it will lose some time value. So it works against us. But because the earnings date will approach sooner and sooner and sooner, we expect that the implied volatility will rise, and the implied volatility will offset some of the loss in time value, and because of that we expect that we'll be able to sell those back. The winning option, we'll be able to sell it back at a profit large enough to offset the money we spent on the losing option. And of course, if it rises, it has the bonus that this put will expire worthless, so we don't need to buy it back because it will simply die. And this sort of reasoning is the one underlying the strategy. This is, if I had sold also a call expiring on July 11 with a 31 strike price, this would be a double calendar spread, because basically you are selling a strangle to buy another strangle expiring 1 week after. But because we don't have shares of Alcoa, we cannot sell calls without having the shares as a collateral, because our account is not configured to sell naked calls because of the risk that it entails. And so this is the best that we can do to offset some of the price or some of the value that we have to pay for these options, these long options. And we use a lot size of 5. All right, so this is something that probably I should have done it a little bit differently. I should not have used such a large lot size. This ended up being a quite big position. But yeah, this is the first time we are trying, and let's see what's going to happen. We did the same thing with American Airlines. American Airlines will also have its earnings release next week. As you can see here, I think it's on Thursday, if I'm not mistaken. Let's see. And let's see. Probably on TradingView it tells better. Yeah, it's on the 17th here, as you can see. And now, as things stand at the moment, we are we're going to do the same thing. We use a smaller lot size with American Airlines. We use just 2 contracts, and hopefully this will be the first of some of these trades that we will do, because we are trying to select stocks which are reasonably volatile and not with a very prohibitive cost in terms of stock price. So yeah, even if we ended up having a small loss on this one, on these combos, we will continue to pursue this strategy, because at the end of the day the potential profits are large, and the losses at the end of the day cannot be too significant, because as you can see there, the largest loss that we can have is if the stock, which can never be too much, because even in the worst case scenario, if the stock doesn't move and the volatility does not rise that much to offset the decay in time premium, we get a small loss. It can never be too significant. And even if the stock moves sharply to down, these puts will become very, very valuable, and we have to buy them back at a loss. But also these puts will become very valuable, and these puts are always more valuable than these ones. So we will be able always to offset a large portion of any loss we may have in here. So the losses on average will be small, but the profits will be always quite large. Can be quite large. As for the rest of the trades, we did nothing with Pfizer. These calls continue to trade in the money. We have until the end of this week to see where the price will fall at maturity, to see if these are assigned or not. We are waiting also to buy back these puts, because these puts at the end of the day are not doing much, and because these calls are all in the money, probably we are not going to sell more puts. We simply buy those back and use these proceeds, the collateral that is tied up to these puts, to basically do more trades of these and see what happens. Because if these calls are assigned, we no longer have shares of Pfizer. We only have 40 shares, but we may sell it in the open market anyway. And so we continue to having puts, the puts will can potentially give us more shares, and if we sell these, there's no point in getting more shares, because we offloaded the entire holding. And so we'll see what's going to happen, but so far the plan now is to buy these back. Now, and of course we continue to do the wheel on the IWM. We sold 7 contracts with a 220 strike price. The probability of profit here was 85%. I did not consider the probability of profit here with the combos, and the reason for that is because the probability does not mean anything, because the probability says what the market implied probability if we keep the combo until its maturity. We are not going to wait until the maturity of the combo. We will unwind the entire positions at the end of this week. We will not wait until the end of the next week to let the combo expire completely. So the probabilities of profit does not matter. Here with the IWM, it's trading slightly in the money, but we will have to wait for it to become almost worthless to buy it back, and see if we roll over the position to another strike price, or and this is something that I forgot to mention before in the last video. One of the things that we may have to do is, as you can see here, in the IWM, in the option chain for today, for example, you will see that the option chain is much less deep than the option chain on the QQQ. So by the time these options that we sold, these puts that we sold on the QQQ, on the IWM, become worthless and can be bought back, chances are no more IWM puts will be available for us to sell. And if we have still some time available at the end of the session to do some trading, probably we will come back to the QQQ to sell some puts and collect some more premium, because as you can see here, the option chain in the QQQ is much deeper. And so there we will continue to use that cash, which is now tied to the puts on IWM, to collect some more premium on the QQQ. So we are not completely letting QQQ go, but it's not a priority. Priority is the IWM, but at the end of later in the day, if no more IWM options are available, suitable options are available for us to sell, puts available to sell, we will revert to the QQQ just to finish the day. And for now, this is it. These are the only combos I will put this week. At the end of the week, we will unwind the trade. The cash will be released, the collateral, and we'll get to see the results. And then we will continue to do this strategy for next week, depending on which stocks will release its earnings. We are going to try to be very careful in our stock selection to do this. Of course, volatile stocks with a not that high stock price, because otherwise you can only one contract, one lot size consumes almost all of our buying power. And we don't want that. We want to diversify our trades. But yeah, we'll see. For the time being, feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you want to ask me any questions. And of course, feel free to like the video and subscribe to the channel. And we'll reconvene at the end of the week to see how the trades played out. And yeah, I'll see you there.